Welcome to Mass Financial Q4 FY18 earnings call hosted by ICICI Securities. Today we have Mr. Kamlesh Gandhi, Chairman and Managing Director, Mr. Mukesh Gandhi, CFO, and entire senior management team with us on this call. I will now hand over a call to Mr. Kamlesh Gandhi to take us through the Q4 FY18 numbers, and then we'll open floor for Q&A. Over to you, sir.
Thank you, Ranish, and good afternoon, everybody. I'm very happy to connect to all of you once again. I have with me Mr. Mukesh Gandhi, who is a co-founder and Director of Finance, Ankit, who is the VP Finance, Darshana Pandya, who is the Executive Director, looks after operation, and Dwanil Gandhi, who undertakes the fintech initiatives in the company. I think all of you are aware about the company, but just for the benefit of the ones who are joining for the first time, Mass Financial Services Limited is a 23 years old, and we focus in serving informal class. And over the period, we have grown at a CAGR of 40%. If you see in the presentation, our first balance sheet size was 2 crores way back in 1995. And what have we done over all this 23 years is to create a quality portfolio, grow in a calibrated manner, and which has resulted into a AUM of 4,114 crores as I talk to you. So this is the brief history of Mass. We went to the market in October 2017. We are thankful to all the investors for the enormous faith they showed in the company. And we as a management and the founders will always strive to live up to the expectation of the investors and the lenders. And this is what we understand we are mandated to do. Just to take you through the performance, the purpose of this call is to take you through the performance on a quarter-to-quarter basis and on a year-to-year basis. As we have mentioned in the press release, it's a very robust financial performance. If you see our quarter-to-quarter performance, we have grown our AUM by 30.36%, income by 35.12%, profit on a quarter-to-quarter basis has almost doubled, mainly because of the money raised during IPO. And we have maintained a very benign quality of asset at 0.91% net NPA. And if you see on a year-to-year basis, the AUM growth, as I told, is 30.36%, total income up by 25.29%, profit before tax and profit after tax up by close to 53.5%, and once again NNPA at 0.9%. If you see the financial metrics, we have always endeavored to maintain an ROA of close to 2.5 to 3%. This time we have maintained 3%, and that translates into a ROS of close to 17% or more, even on the expanded base of capital. If I take you through the segment-wise performance, as you know that we are a specialized MEL and SME financiers, and bulk of the business is booked under this category, where we serve the small and the medium enterprises of the country. In that, in micro enterprise loans, we have around 29.8% of growth, which has grown to 2,576 percent. In SME loans, we have crossed 1,000 crores, that is 1,029 crores, which is around 34.78% growth. Two-wheeler is 362 crores, which is 27% growth. And commercial vehicle has grown by 20% to 146.22 crores, resulting into aggregate AUM of 4,114 crores. If we see, as you know, we operate our housing activities through our subsidiary, that is Mass Rural Housing and Mortgage Finance Limited. And there we have registered a growth of 15% in AUM, 17% in profitability before tax, 28% growth after tax. And we have improved on the quality of the portfolio. That is, from 0.34% NNPA, we have managed to control our NNPA to 0.27%. And if I've interacted with many of you many times, that we always believe that as an intermediary, we are mandated to create quality, because in lending business, top line is the easiest thing to do. And as a company, we always endeavor to see to that how we can keep the portfolio very benign. Briefly, if I share with you that what has been the key enablers over all these years, and this year being no different. If we talk about our performance, we have been growing at a very steady pace of 25 to 30% in AUM and in profitability, a very strong compounding story over all these years. We have doubled our AUM and profitability every 3 years, and we will continue to do so, and the endeavors is to do so that in the future also. Now, if I share with you what are the enablers due to which we can post this robust growth on a year-to-year basis, I must start with the market size. That the size of the market, what we serve, is a huge market out there. The SME, the difference between the demand and the supply of loans to the SME and the MEL is well known. But as it is known that every business opportunity is as good as you execute it. So the market size has always been a very big enabler. But accompanied by that, our understanding of close to 23 years of the segment and the sector. If you ask me, we know nothing but to serve this informal class, especially belonging to MEL and SME. And over a period of time, you always learned, unlearned, and have always tried to be more and more efficient in the last mile delivery of credit. And if you ask the USP of the company is understanding the segment whom we serve very thoroughly, and which is reflected in our execution. If you see our distribution pattern, how we distribute this last mile delivery of loans is through 2 distribution channels. One is our own distribution strength of close to 3,300 centers spread across 6 states and 77 branches. And through 112 smaller NBFCs who are very closer to the ground. So ultimately, even through NBFC, whatever we do is creating the ultimate portfolio of MEL, SME, two-wheeler and commercial vehicle, which we do directly through our distribution network. But rather, we have always believed that rather than opting for a DSA or a franchisee model, NBFCs have always proved to be a superior model in terms of the efficient last mile delivery of credit. And hence, we are channelizing that part of the credit through NBFCs, whereby we have a revenue sharing model with them, and they originate and they service and bear the delinquencies also, and the revenue sharing model is done accordingly. I think I've shared with you in the past also that we used to work in the same model with HDFC Bank in 2002, 2003, and we had a wonderful experience. And from that time onwards, we always thought that this is a very potent way of doing the last mile delivery of credit, because in serving the informal class, it is not about the size of the balance sheet that matters, but it is about the demographic understanding. And we started with just one relationship in 2010, and as I talked to you, we have such 115 relationships. So the understanding of the segment has resulted into a very potent and a very robust distribution network through our NBFCs and through our own distribution strength of 3,300 centers. And secondly, understanding of the segment has resulted into a very robust underwriting practices and processes. I think when it comes to underwriting, Darshana, who handles the operations, will talk to you much about it. But we always, over the years, have believed that extending credit where it is due is the ultimate aim, and we always endeavor to do it. And the quality of the portfolio is the result of the stringent credit what we do, is the aggressive write-offs what we do, and the strong collection that is. And what we mean by strong collection is being very close to the entrepreneurs and very close to the borrowers whom we fund, right from the first default, to make them understand and see to that the burden on them does not increase to that level whereby they are not able to pay. And this has resulted into a very constant and a consistent quality as far as the portfolio is concerned. Because we firmly believe that increasing the top line in financial services business is far more easier rather than to strike a balance between growth and the efficient last mile delivery of credit and the quality of the portfolio, which we have done over all these years and will continue to do the same. As a result of which, this company has become a self-propelling mode in terms of the capital requirement also. If you see in the last 23 years, we have raised the primary capitals only 3 times, including IPO. Out of that, out of the total 5 to 6 capital raised, 2 were redeemable, 1 was secondary, and 3 were the primary raise. So this company has the potentiality to grow through its self-accruals, which were demonstrated over all these years. And when I pass it on to Mukesh Bhai, he will talk much about the strategy on the liability side. So this is the performance for this year, that we have grown at a rate of 30.36%. The profitability has grown at a higher pace at 53.44%. But this is because of the IPO money raised in the second half, that is in October 2017. And the quality of the portfolio has been very benign, considering the fact that we all know that this was a very challenging year. Last year was a very challenging year. And I must admit that I cannot take all the credit for the quality of the portfolio. I have to give the credit to the people whom we work with, the borrowers whom we work with, the entrepreneurs whom we work with are so resilient and are so hardworking that irrespective of the fact that they face a lot of problems, their problems were not passed on to us and they could maintain a good credit discipline, which has eventually resulted into a quality portfolio that we always long for. I would like to share with you about the HR policy at MAS, because every company is as good as its team. And what I personally believe, that team is a group of people having complementary talents. And I must tell that at MAS, we are having a very efficient team. And I'll be failing in my duty if I don't acknowledge the role played by my core team, who are with us for more than 25 years now. We have close to 30 to 35 people who are with us since 1995, and they continue to head the main functions at the organization. Because being a practitioner, if I share with you, in a lending business, internal risk is far more than the external risk. Because a single loanee has an influence of only one loan, whereas the person managing many loans can pose larger risk. So we are very circumspect on how we select our people. We have a very good core team. We do the lateral recruitment from time to time in order to match the growth and to give the professional touch. And the way we have grown over all these years is with the dictum of we fail together and we succeed together, whereby it has given the sense of proprietary to each and every employee, each and every person who works over here. This is our strength and at the same time the challenge too. That every time I talk to my colleagues, the only aim is that how we can inculcate the proprietary attitude in them. And once the proprietary attitude is inculcated, the things becomes very easy. So we have a very simple HR policy that we consider everybody and we try to see to that sense of proprietary is instilled in every one of them. And I'm very happy to share with you that few days back I had one SME client talking to me that what are you doing that everybody I meet at MAS, I feel like that they are the proprietor of the organization. But that is a very conscious effort on the part of the organization to make the employees feel that they are the part and the parcel of the company and they are the owners of the company. So overall, these are the key enablers: the market size, the understanding of the segment, the way we distribute our products because of our understanding, the underwriting practices, and the HR management. And a few other things in detail will be shared by my colleagues. And for the liability management, I would like to pass on to Mr. Mukesh Gandhi, who will take you through the strategy on how we raise liability. Because in a financial services company, assets and liabilities both are equally important and I will call it interdependent for the robust performance of the company. So I'll pass on to Mukesh Bhai to talk to you about the liability management strategy as to what is our strategy over all these years and how we like to carry forward. Mukesh.
Good evening, everybody. So far as the liability is concerned, if I take you from the car, currently our capital adequacy is 31.29%, and this high capital adequacy is due to the infusion of capital into our IPO. Out of 31.29%, 29% is Tier 1 capital, which is almost 3 times the statutory requirement, because statutorily you require 10% of Tier 1 capital, whereas we have a 29% of Tier 1 capital and 2.23% of the Tier 2 capital. So basically we have always gone through a self-propelling business model, as Kamlesh bhai told you, that with the internal accrual, we keep on growing we keep on fueling our growth. And as a result, over a period of time, we have raised the capital very judiciously. And going forward also, we will make the best use of capital to enhance the shareholders' value. Now, the very important another aspect of our liability management is that we keep on assigning portfolio to the tune of 35 to 40%. And when we assign this portfolio, it is de-risked from my balance sheet, and we don't have to provide capital on that. Secondly, when I assign the portfolio, it qualifies for the bank as a retail portfolio and priority sector portfolio. So banks offer us as a very finer rate, and that helps us in maintaining the overall cost of borrowing under the control. So if you look at our cost of borrowing, in the last year our cost of borrowing was 8.67%, whereas the cost of fund, including the impact of capital, was 7.74%. So this is what we have been maintaining, this very controlled cost of capital, cost of borrowing, because of our relations with the banks and the various mix of raising the liability. We raise the liability through CC facilities. Within the CC facilities, we go for the short-term working capital demand loan. We raise certain term loans. We go for an assignment. And because of all this mix, our cost of borrowing is less. We also issue the commercial paper whenever the rates are very conducive. And we have excellent relationship with our bankers, and we have a consortium of almost 20 banks. And the same bankers are buying our portfolio because they are aware of the quality of the portfolio, what we are generating it. And because of that, they are very happy to buy this portfolio periodically. If I take it to the performance, so far as the NIM is concerned, we have an average deployment rate of around 15.77%. Cost of fund is 7.7%, and that leaves the margin of 8%. And from that, the cost of provisioning and delinquency is 1.35%, and operational cost, that means is 2.08%, leaving 4.6% as a net profit margin. And if you look at the return on average asset, it is 4.41%, and return on average AUM works out to be 3.01%. And ROS, the return on average capital, is 19% on the extended capital base also. And going forward, we are hopeful of maintaining this around 19 to 20%. Now, so far as our LM is concerned, we have very, very good match also so far as the asset and liability is concerned. Our current ratio, if you look at that, it is more than 1%. And let me clarify that in this current ratio, our CC facility is also included. And we utilize 45 to 50% of CC facilities every year. These CC facilities is the continuous facilities practically. Technically, it is considered for a 1-year facility, but practically it keeps on renewing it. So if you consider that also, then we have a robust ALM at place. And going forward also, we will continue to have that robust ALM mechanism at place. So far as the interest is concerned, now the bond market is tightening up and the rates are going up. but basically we have a relationship with the banks, and till today we are getting the funding at the final rates. If we go for the issuing the NCD or bond, then a lot of people are ready to fund us. But given our present rating of A, the cost difference is between 100 to 150 basis points. Therefore, we are refraining ourselves from raising that particular source. Otherwise, at any given point of time, we can switch over to the capital debt market and can raise the funds. And that we will do it at the right time once we are finding that the rate are conducive to us. So this is how we are managing our total liability in an efficient manner to control the cost and keep the liquidity always available for the growth of the company. Now I pass it on to my VP Finance for the detailed funding sources and relations what we have with the different financial institutions. Mr. Ankit.
Hello, good evening everyone. Just to elaborate on the liability management which Mukesh sir told, our company primary source of funding are assignment of receivables, cash credit and term loan. Firstly, if I elaborate assignment, last year we did around 1,800 crore assignment transactions, majorly with PSU bank like SBI, Bank of India, Union Bank, Dena Bank, Oriental Bank of Commerce, Andhra Bank, etc. The assignment transaction help us to save on our capital, as well we do it at a very competitive rate. Almost all the transactions which we did last year was at 1 year MCLR of banks. Last year, our incremental cost of assignment transaction was around 8.75%. Secondly, if I talk about cash credit, this helps us in maintaining sufficient liquidity in hand. We have around rupees 2,000 crore cash credit facility evenly spread over 20 banks. Here, the lead bank is Dena Bank, who was our first banker since 1996. The major banks are SBI, Andhra Bank, Bank of India, Union Bank, PNB, Bank of Baroda, etc. Here we always make sure that around the year the utilization of CC facility should not be more than 50 to 60%. Here again, in order to reduce our borrowing costs within the CC limit, we have sanctions of WCDL, which we roll over each 3 months. The rate which is the WCDL are majorly at banks 3-month MCLR. Last year on incremental basis, the cost to WCDL to us was around 8.25%. Thirdly, in order to manage comfortable asset liability maturity pattern, we keep on raising term loans. Last year we raised around 225 crore term loans with various banks, namely HDFC, Bajaj Finance, etc. And the incremental cost of term loan was 9.25%. Now I hand over the speaker to Ms. Rasna Pandya, who is our CEO and Director.
Good evening, everybody. I'm Darshana and I'm working in operations since last 22 years. I'll share some credit underwriting practice with all of you, as it is an important part of our operations. With an aim, as mentioned by Kamlesh sir, with an aim to extend credit where it is due, what we do is we design the credit policy for all our products. And for that, what we consider is the demographic understanding and the product characteristics while designing the credit policy for all these products. And then what we do is we follow the dictum of adherence and adaptability. We train our team for the policy and guide them to adhere to the policy. And based on the feedback from our origination team, portfolio management team and credit team, we adapt the policy on regular basis rather. So that this keeps us very relevant at the marketplace and which helps us to create the quality portfolio. Now about the credit processes, though it's centralized, it's seamless for the customer. We are sensitive to turnaround time to process, to deliver the credit. But at the same time, we are not obsessed for that. And that's why we have set this process in such a way whereby customer doesn't feel that it is centralized decision. So, for credit processes, what we do is we collect the information from the customer as we are serving to informal class of the customer. We collect required documents for their KYC and other checks. As they are from informal class, they are not in a position to prove their income on paper. But in that case, we have to understand their business model, and based on that, we have to take the decision, final decision. And our credit decision is aided by our on-site credit verification, site verification, input from our collection team, and credit bureau checks. And this also helps us to create the quality portfolio. Here, the challenge is to systemize our learning, which is our USP also. What we do is we design the credit policy, then train our team. And learning and unlearning is the continuous process at mass. And based on that, time to time what we do is we adapt the credit policy and once again train our team, and this is the continuous process at mass. Now, to sum up, what we do is we design the credit policy, we have audit system at place, and we have risk and monitoring also at place. So this gives us 360-degree view. Credit policy and process helps us to analyze the current situation of the customer. Audit is there to give us the insight, and risk and monitoring is there to give us the foresight. So this is how we take our decision for final credit delivery and create a quality portfolio, which is a continuous endeavor of mass. Now I'll request Dwanil to throw some light on technology development, which also helps us to improve our turnaround time and create the quality portfolio.
Hi, good afternoon to everybody on the line. I'm Dwanil Gandhi, working as a BDM and also working closely with the technology team at MAS. For MAS, optimum use of technology to achieve our goal of efficient last mile delivery of credit and providing credit where it is due is at the forefront when we design any of our technology initiatives or undertake any of our technology initiatives. And some of the projects that we are constantly working on currently is developing a very robust MIS system, internal MIS and dashboard system, which can give live feedback and data to our management for the decision making. And some of the initiatives on the sales side is designing applications where we can track the activities and the efficiency of the salespeople on the force who are generating the retail loans for us, and to make sure that wherever we can guide them on the basis of their activities, we always do that. And we are also working with outside companies. So at MAS, we have an internal technology team in place who develops the applications like our core banking and all of those major applications. And we also work with a lot of software providers where we take certain specialized softwares which will help in increasing the efficiency of our credit process and underwriting. And just to share with you guys a few examples is, for example, a bank statement analyzer. So we deal in our SME product with very bulky bank statements. So we have an application which will analyze the bank statements and give us certain outputs which we require for our credit decision taking. And we are also working on e-training. That is also a new initiative that we have undertaken for training our sales force, our credit people, and everybody who is working on the ground. So we provide training through gamification, making it more interactive, making learning more interactive. And on the fintech front, as the name suggests, the financial prudence is of vital importance while undertaking any fintech activity. And as far as MAS is concerned, because our customer segment is informal, that is why still touch-based solution, touch-based interaction is still the most efficient form of interaction that is there, because we need to personally meet them, go to their workplace, go to their home and understand their working and and get the maximum information that we can by talking to them. So this is a brief update on the initiatives on the technology front. I will now request Mr. Kamlesh Gandhi to take it forward from here.
So thank you, all of you, for elaborating on the processes at MAS. So now I'm coming to, I think all of you must be interested that what next. So just guidance on how we have planned internally. We had a board meeting today morning, and what we are planning is that once again grow at around 25% next year. So including our housing finance, we should look like close to 5,200 to 5,300 crores next year, maintain the quality of the portfolio, end up at a PBT of anywhere between 190 to 200 crores, once again a 25% rise. This time a 53% rise is because of the money raised in the last year, but we have now we'll be growing on the expanded base of profitability, and we will endeavor to create more and more efficient last mile delivery of credit, increase our distribution strength from current 3,300 to 3,600 plus, concentrate on how we can add value working with our retail assets channel, and once again constantly endeavor to systemize our learning in terms of credit. And once again, as I shared with you, the very important resource for any organization, the human resource, we will constantly endeavor to upgrade them, to take them to the next level, and together we succeed. And this is how we will see to that how we march ahead towards our mission and vision of maximizing the shareholders' value and becoming a very responsible intermediary. So that's all from us, and let me tell you that we have been doing this since many years, and we are at a very strategic inflection point now. At 5,000 crore, we just go on doing what we have done and have a sharp learning curve. This is how this can be a very big financial services company in the making. And this is what we are committed, as I always tell that we are committed to, if you see our punchline, is always excellence through endeavor. So we remain committed to our mission of excellence through endeavors. Thank you so much, and now a Q&A may be arranged. We can start with the Q&A, please.
Sure, thank you very much. We will now begin with the question and answer session. Participants who wish to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Sudhanshu Mishra from Motilal Oswal Securities. Please go ahead.
Hi, thank you. This is Shubhranshu here. So I just want to understand within your SME segment, one is I want to understand how do you assess the income of the borrower? Second is what is the quality of collateral that we accept? Third is what is the asset to the loan value generally we take during disbursement of the SME loans?
So as far as SME loans are concerned, our primary focus is to give loans against machinery, against shades, and working capital loans against hypothecation of the current assets. In terms of loan to value, in terms of shades, it is anywhere between 55 to 65%. Machinery is around 75%, and the same in the case of WCL, whereby we have a practice of taking cash collateral in WCL to the extent of 25%. So this is how we operate in terms of our SME portfolio. In terms of assessment of income, it is a multifaceted approach that we see first of all, it starts from evaluating the entrepreneurs, the business models, all the available papers, what they can give, our understanding on the sector, and we combine everything and draw out their cash flow and assess their income. So having served this industry for a long, we are aware of so many industries. We serve to as many as 600 different categories of customers, whereby we can understand their cash flows, income, and profitability. So once again, as I always tell, that this is a task we worked upon. We continuously work on improving it. If you see our credit appraisal memo in June, it will be different. In September, it will be different. In December, we go on adding as to how we can be more and more closer to the reality. And very importantly is our approach to this class of customers. We always approach to them as their advisors and not just their lenders. And our interaction with them makes it possible for us to understand their real reality at the ground, because it is very important to extract the real information from them. So that we have been doing, evident from the quality of the portfolio. If I give you the quality of the portfolio in SME, the NPS there is 0.68%. So this is how we carry on our SME business.
Right, sir. And just one follow-up question on this, sir. You source this particular SME loans only through your own channels or through NBFCs as well?
Both. It's both. It is both the way. We source through our own channels and through NBFCs.
And what will be the split in that case, sir?
Around 55 to 60% is direct through us, and 40% to that.
Right. And just one last question, sir. How do we look at the growth of this particular portfolio, and what kind of asset quality or can we expect going forward as well?
I'll answer the question in that way, that we will grow our portfolio if we can maintain the asset quality. We never believe in just growing the portfolio. So I'll tell you that we'll try to maintain the portfolio quality within our set targets in our costing. That is, we don't see the NPS more than 1% or 1.25%. 0.68% is a very extraordinary achievement on a relatively smaller base of 1,000 crores as we go ahead, but that will be inbuilt in the pricing. So the quality should commensurate the pricing. At the end of the day, it should send a litmus test of what returns it can generate for us. So quality will be of the prime importance. If we succeed in that, this should grow at around 35 to 40%.
Right. Thank you so much for your time. So I'll come back in the queue.
Thank you.
Thank you. Next question is from Madhujanda Dev from MC Research. Please go ahead.
Hello. Hello.
Yes.
Yeah. See, I have two questions. One is, nowadays, if you talk to any banker, the focus seems to be incrementally on getting the books granular, focusing on SME. And even the PSU banks in their, once their whole this restructuring process is over, there are talks of creating specialized institutions for SMEs, specialized banks for SMEs. So the competitive intensity is going to be of a very different order. So how do you respond to this? Hello.
We have been working in this space since last 20 years, and everybody was present. The focus, as you rightly told, has increased. But at the same time, it's a huge market to be served and a very customized market to be served. At the ground level, there are many more markets within the market. The bank concentrating on one niche segment, the other bigger NBFCs concentrating on the other segment, the NBFCs like us concentrating on a different manner with 5.1 crore SMEs. And if Indian GDP is to grow at 7%, this will contribute around 40% of the Indian GDP. It's a huge market to be served. So the market size is never a problem. And if you see in the Indian lending space, nobody has ever suffered because of lack of market. Everybody has suffered because of the lack of the quality of the portfolio. So the right way of looking at it is that, as I told you, in lending, increasing the book is very easy, but to increase the book in a call and maintain the quality is very difficult. And that is where there are very high entry barriers. So as I told, the market is huge. We have a very powerful distribution network, and accompanied by our strategic intent of creating quality portfolio, we will be creating a very sustainable growth in this portfolio, and we are very confident about it.
Okay, thanks. My second is a housekeeping question. I wanted to know the slippage numbers for FY18 as well as FY17.
That will be shared with you. I don't have the exact now. So if I tell you about the NPA as on 31st March, it is 0.68 in SME. Overall, it is 0.91. And the slippages will be shared with you in detail.
Okay. Yeah. I mean, over the quarters, has there been any difference in the trend of slippage? If you could just highlight that.
Come again, please.
Over the quarters, has there been any change in the slippage pattern?
See, usually what happens is that the slippages depends upon number of factors. But what we have seen is that because of the efforts on collection and all, ultimately the net result comes out to be the best in the last quarter. But there are no set trends that this quarter will have higher slippages or this quarter will have lower slippages. It varies from year to year depending upon the macro situation and about the industries with whom we are working and about the particular state of the affairs with the borrowers whom we are working. So there are a number of factors. It's difficult to point out the trends. There are different trends every year.
Okay. Thank you.
Thank you. The next question is from the line of Pranav Gupta from HDFC Securities. Please go ahead.
Hello.
Yes.
So congratulations on a good set of results. I have two questions. Firstly, if I look at your costs, so other expenditure has dropped sharply. Any particular reason for that?
Other expenditures. Give me a minute. I'll have to.
So other expenses are at
it is not. It was 33 crores in 2017. It's 33 crores in 2018. Almost same.
So if I'm looking at the quarterly run rate, it's about 7.5 crores this quarter versus an average run rate of about 8.7. So anything to read into that, or just a quarterly?
It's a routine business affair. If I tell you on the way we conduct the business, there's nothing extraordinary which would have increased other expenditure.
Okay. And the second is just a clarification. So if I look at your presentation, the breakup of the bucket-wise NPA that you have given on the AUM, that's on slide 22, says that so if I sum up the 90 and 120 DPD plus, comes up to 0.73%, whereas your NPA is higher. So is there anything I'm missing out, or
See what happens that once the account is classified as NPA, it can be NPA sitting in other buckets also. So once we are classified as NPA, unless it becomes regular, we still goes on classified as NPA.
Okay.
We don't do reverse migration.
Okay. All right. Thank you so much.
Thank you.
Thank you. Before we take the next question, we'd like to remind participants that you may press star and 1 to join the question queue. The next question is from Digant Haria from Antique Stock Broking. Please go ahead.
Yeah, so again, continuation of the previous participant's question on operating costs. Sir, I see that in the last 2 years, our AUM has grown roughly by, say, 1,400, or 1,500 crores. And our operating expenses, all kinds of operating expenses have just grown by, say, 17 or 18 crores. So we are practically adding 100 crores of AUM with just 1 crore rupees of operating expense, which includes the employee cost, technology, and all possible costs except interest cost. It's very, in India, there aren't any retail businesses or SME businesses which are able to do, such kind of things. So, firstly, I wanted the wholesale piece, last quarter, I think it was 56%. I want that number if you can give me for, March 16 and March 18, if I can get that.
See, once again on the cost part, if you see that we get there are two things. One is the way we distribute our products. We distribute through NBFC. Once again, I for one, for very practical reason, will not call it as a wholesale lending because it is not the strategic intent. We don't finance through NBFCs into gold or real estate or corporate funding. We only have NBFCs as our channel partners who are in the similar line of activities. Just a clarification on how we work. Technically, it looks like wholesale funding because we channelize this assets through their books. Otherwise, it is just like another NBFC appointing a DSA or a franchisee, but with no recourse on them. But this is the first part. Second is on the cost of the operation as we increase the size, and secondly, the way we distribute our product, it is upfronted in the revenue sharing. If you see my yield, they come down in terms of when I lend it through NBFC because I pass on all the benefit of operational costs, the delinquency and the servicing by charging them less. It is if I give you the more detailed picture, our average yield on our retail assets, what we do through our NBFC channel, is 13.96, which was 2 years back close to 15%. So this is how the cost is covered in the yields because there is a revenue sharing model. So in the rest of the business, what we do will increase what we do directly will increase our cost. And that is why we are in a position to maintain our costs at around, say, 2.2%. It is a function of our distribution cost and the expanded base.
Okay. And just the proportion of, this channel partners in the overall AUM.
I just give you 1 minute. Currently, it is 58%.
Okay. And then this number 2 years back would have been similar, or would that?
16 was 55%. So it is in the range of 54 to 58% this year.
Okay, sir. Thank you and all the best.
Thank you.
Thank you. The next question is from Piran Engineer from Motilal Oswal. Please go ahead.
Yeah, hi, sir. Just one or two quick questions. Firstly, I noticed that we've drastically increased our branch count from 77 to 124 this quarter, and bulk of that has come in Gujarat. So anything in particular that we see that we've, almost doubled our branch count in 1 quarter?
No. Branch is still 77 in parent company. This number are for consolidated. It's of MFSL and MRHFSL both.
Okay, so the incremental branches have come for the subsidiary. That's how I take it.
So 77 is of MFSL and subsidiary 69, and out of that 22 branches are shared branches. Yeah. Right now, I think you are looking at consolidated presentation.
Okay, got it. And also, if you could just tell us the incremental yields in each product, that would be helpful.
Yeah, please come again.
The incremental yields in each product, like in MEL, at what rate are you lending today? In SME, what rate you are lending today? And in each of your 5 segments.
So in our MEL product, it's around 15.42%. SME is also 15.46%. Two-wheeler is 18.18% and FY2 is 17.51%.
Okay, this is as of 4Q, right? Incrementally.
Yes.
Okay. Thank you so much. That's it from my side.
Thank you. Anyone else who wishes to ask a question may press star and 1 at this time. As there are no further questions, I'd like to hand the conference back to the management for any closing comments.
So, thank you so much, everyone, for joining this con call, and let us once again assure that we would stick to our mission of enhancing the shareholders' value. We have been doing this since many years, and will continue to do that. And suffice to say that our actions will speak louder than words. Thank you so much.
Thank you very much. On behalf of ICICI Securities,